All right, guys, welcome to episode 12 of the Pale Horse Podcast. I have Shawn, and we're going to go over financial preparedness. All right, so episode 12, financial preparedness. I think that finances is one of the top 3 categories that you guys have sent us that you want a podcast on. So, of course, there's no one better to do it than Shawn. And so I'm happy that he's on the podcast, episode 12, to really dive into the finances and take this podcast over for this episode and talk about all the stuff that I need to learn, probably more than you guys need to learn. And so I'm going to let Shawn introduce himself and kind of take it away. And I'm going to pose some questions to him and throw some curveballs at him. And it's going to be a really good episode, especially for you guys wondering about your financial preparedness or how to better financially prep, or maybe how to prep, but you're worried about finances. And so that all kind of will go hand in hand. I'll introduce yourself. I know most of the guys know you're on here, but a little bit about pre-Apex background, maybe.
Pre-Apex, there we go. Thanks, Ryan. So I'm Shawn, and if you on the website, you can see my tactical resume. But what we're talking about today is a little more to do with my resume before Apex and after the Army. So I was in banking for, I guess I could still say I'm still in.
Still in banking.
Over 30 years. How that was split up was 14 years at the Federal Reserve as a bank examiner, and then basically 16 years plus as a banker. So I wasn't just a bank critic, I was a banker too. But the time with the Federal Reserve as an examiner, you got to look under the skirt of the largest banks and the community banks and regional banks, which are the new hot topic. For many years, both from a safety and soundness standpoint and a consumer protection and legal regulation standpoint. Then as a banker, I was also in that world of bank regulatory law, consumer protection, anti-money laundering, anti-terror finance, and those areas as well. And what this has done is just given me 30 years of exposure from a part-time teller up to a senior vice president of a large bank. Exposure to personal finance and some of the pitfalls of personal finance, what economic shocks do to people, what losing your job can do to you, and how to prepare your finances so you can weather these storms, whether it be a stock market, a job loss, an EMP, etc. So that's kind of my background.
He's the best to be on here. So I have a ton of things I want him to talk about, such as financial prepping. I know some of you guys have mentioned crypto, and like my concern, of course, is always globally world trends with finance. The dollar stability versus instability question. Of course, China is the big bear in the room in regards to financial players. And I've had a bunch of students throw around like the debt ceiling debate and what is that going to do long term. I received a very interesting article today on the COVID economic impacts from now until 2026 and what some of those third world countries what that's going to look like the next couple of years and how that might affect, all the way down to you guys saying, man, I really want to buy night vision, or I really want to buy a rifle, or make a $200 bug out bag, but I just really can't afford it right now, or 1,000 rounds of ammo, but I really can't afford it right now. So what are some maybe tools to set up how you can kind of prep on your still fixed limited monthly income? And so Shawn's going to talk about some of that stuff, and I'm super happy because I need this more than you do. So that's why there's a SIG spear in the background, because I make poor financial choices. Oh, great rifle. Just I didn't need it for the money, but great rifle. So it's fine. We all make impulse buys. I'm the impulse buyer.
Yeah, but I'm jealous. So it's a beautiful guy. So we want to start off with kind of world threat, like
love that
macroeconomic threats and things like this. Some of the items that are front of mind right now. So we look around, we see everybody's talking about recession. The Fed's been raising rates at a record pace, the fastest in history, and that's quite a bit of history since the Fed came around, in 1911?
Yeah.
And basically to try to slow down an economy that had been stimulated by tons of cash, both from COVID relief funds and zero interest rates for, again, a record period of time. Over 10 years, we had basically zero interest rates. That heated things up. And inflation's a little bit, you're going to hear fire from me a couple times, but inflation's a little bit like a brush fire. It starts off benign, small, easily controlled. If you let it go, it turns into an inferno. And it was let go for too long. Now the Fed is trying to tamp it down, and one of the way the Fed tamps it down is raising rates to stop people from spending. If you think about it, let's put this in every day. Let's get out of the macroeconomics and think about every day. Some of you might have some money that you just put into CDs, right? Because the CD rate is 4%, 5%, depending on which bank or what you're investing in. Pretty much anybody can get a 4% CD right now. That's been unheard of for over 10 years. Maybe instead of using your credit card to buy that dinner, you just did fast food and paid for it with cash. All this is a result of the Fed raising rates. The Fed raises rates, it raises your credit card rate instantly. It raises your home equity loan rate instantly. It raises your car loan. It doesn't raise it if it's a fixed rate, it won't raise it. But if you want to go get a car loan today, it's going to be up 5% from what it was a year ago because the Fed has raised rates 5%.
Oof.
So instantly people start pulling back on economic activity, things like buying cars, buying houses. They're still taking vacations. But buying big dollar items get cut back immediately because it's more expensive to borrow. Also, there's an opportunity cost when there was no interest rates that, why leave it in my bank account earning nothing or 0.01% when I can go buy a new car.
Right.
Or a new motorcycle or a Sig Spear.
That's what I do, buy guns and ammo.
So it's that's how you slow down economic activity, by raising rates down at a granular level on decisions all of us make every day. And it's working, but it's a very slow tool. The economy's massive, and we had so much money running around. I thought people would find this interesting. The stimulus bills for COVID, Congress approved $2 trillion, okay? Do you know how much bank accounts went up after those went out? This was to save people, so they could spend and pay their bills during COVID because of job losses and other hardships. And I'm not saying there weren't hardships out there. There were.
Sure.
Bank account balances went up $1.8 trillion.
Really? Out of $2 trillion?
Out of $2 trillion, bank balances went up $1.8 trillion.
See, I bought a new gun and body armor with mine, so I spent mine.
that money more or less went straight into everybody's savings.
Okay? Except for mine.
and a lot of people really needed it. And I'm not trying to downplay the hardship of COVID and all the job losses. But the majority of that money went into bank accounts, and it sat there. Now it's being spent.
On groceries, because my grocery bill is out the roof.
So the balances are dropping very quickly. And that's, again, because the Fed has raised rates. They're either putting them in money markets or CDs or spending that money because of the increased cost of gasoline and groceries and pretty much everything. So again, that's why it's so hard for the Fed to slow this train. This wildfire is burning, and it's burning the fuel that they put out there. It's like they stacked hay bales around the field, and the field caught fire, and now it's burning the hay bales. That being said, the high rates are bringing down economic activity. And again, people are talking about recession because 9 out of 10 times the Fed has raised rates like this. And we won't get into the inverted yield curve, but when you have a seriously inverted yield curve, it's 9 out of 10 times means a recession is coming. May not be tomorrow, may not be in 6 months, but there is one coming.
Are we in a recession?
We're not in a recession yet. We danced with it very closely last year around June. There is a government body that declares recessions.
Okay.
It's not just based on GDP. GDP is a major factor. There's about 5 factors in declaring a recession. It has to do with GDP, unemployment, price activities, things like that, velocity of money, things like that. But we were very, very close to one already in the middle of last year. And now the rates are higher. We're approaching one again. That being said, historically speaking, the average Fed rate for normal times is between 4 and 5%. And we're at 5%, and we think it's a nightmare because we're at 0% for over 10 years. So people are looking at this rate like it's skyrocketed. It's actually just come back to normal from record lows for over 10 years. We got spoiled. In the Fed, we call it taking the punch bowl away. When rates are down low, the punch bowl's flowing and everybody's having fun. When you take the punch bowl away, nobody has any fun. And that's what's happening here.
I didn't know that. That's interesting.
So, yeah, when you look over history of U.S. economic activity. Now, that being said, 5% Fed fund rate, and we won't get into what that actually means. What is a Fed fund rate versus a mortgage rate versus a car loan rate? But let's just say it's a key rate that banks base their pricing off of.
Right.
And when it goes up, everything goes up. I got a message from my bank. I have a home equity line of credit that I don't really use, but it's there. And the day after the Fed announces they raise rates, the next day I got an email saying your home equity line rate is increased by the same amount. It's immediate. So your credit card's the same way, well, within a month or so. So they'll raise your rates on your lending, but they're very slow to raise your rate on your savings, as we've seen. I think the big $1 trillion banks, when I mean $1 trillion bank, I mean Citigroup, JPMC, JP Morgan Chase, Wells Fargo, Bank of America. They're not raising rates on their savings because people are still handing them more money.
Right.
And the longer they keep rates down at 0.05% or 0.1%, and they can lend it out at 15%, that's how banks make money. So there's your banking 101.
And they make a lot of money, a lot more money than I thought they made.
They make good money when in a rising rate environment. In a normal rising rate environment, banks are licking their lips because they make more money on their loans and they can drag their heels on increasing the costs that they pay on deposits. Right? That's in normal circumstances. What happened with the Fed is they raised rates, and we'll get into, unless we want to continue on world financial threats, but they raised rates so fast, no model and no prior experience really dealt with it. So it surprised some of the weaker run banks.
Okay, I was about to ask Silicon Valley Bank, some of the ones in Louisiana that
they're really struggling because essentially they didn't know how to handle. This is a classic bank issue, by the way, since the 19-teens. Okay. There was issues like this.
Great Depression, leading up to the Great Depression.
Right. This is old school bank failure stuff. This isn't mortgage-backed securities like 2008 and derivatives and things that were doubling down the volatility of prices. This is old school duration mismatch, which I'll get into in just a second. If we want to do world financial threats,
we can. Yeah.
Excuse the glasses. It's getting old. Some of the top financial threats right now, and some of these are they go into a scale of really bad and really not very likely to. There's a good chance there's going to be some shocks fairly soon. Conflict with China is the first on my list. China owns a bucket load of U.S. debt. They buy U.S. bonds. I don't know if they're the third or fourth largest. England used to be the largest buyer of U.S. debt. They buy a lot of U.S. debt. I think they've been slowing down in recent years, but they still own a ton of it. If they decided to dump all their U.S. debt on the market and sell it, that would create a shockwave in the bond market. It would drop the prices of bonds significantly. That being said, it would also hurt them. They would take tremendous losses because they would be selling their bonds at tremendous losses. So they would get hit. It's mutually assured economic destruction, which is what would happen if there was an economic war a full economic war between U.S. and China at this point. So they could dump their bonds. People would say they dump their bonds and wreck the U.S. economy and the dollar overnight. Not true. They don't even hold the most bonds. They hold a lot of bonds, but they don't hold as much as 4 or 5 other countries.
Right, yeah.
Also, the rest of the world would look at it and say, boy, these bonds are cheap. Let's buy them. Right? They would probably get sucked up back in normal market activity and purchased. They would create a shockwave, but it wouldn't last probably for more than a month.
Yeah. Huh.
Then China would be out of bonds and would be out of leverage. Right? So that's why they haven't done it. There's the U.S. dollar being stronger or weaker. The U.S. dollar, because the Fed was the first to raise rates. The Fed always leads the way. The United States Federal Reserve always leads the way as far as raising rates or lowering rates. The rest of the world watches them. The Fed started raising rates early and hard, and the dollar gained value overnight, massive value, as people were buying dollars because they wanted the yield, and dollars were in demand because they could get treasuries and things like that. Now the dollar's dropping because the Fed has signaled they're going to slow down on their rate increases.
Right.
While other countries are still raising.
Yeah.
So now they're going to the yen or Australian dollar or things like that.
So what's that going to do, let's say 5-year impact on our dollar?
So 5-year impact, if we get back to normal economic activity and we don't have high inflation, America continues to be the richest country and the biggest economy in the world. People will come back, flight to quality, and they'll come back. Be good for the dollar in the long run. Whenever dollar fluctuates significantly, there's always a double-edged sword. The stronger the dollar, the American dollar buys more, so imports are cheaper. But our exports are more expensive. So nobody buys our stuff. But we can buy more stuff from other people, like China.
Right. So it makes them richer and hurts us,
right,
essentially.
Right. But us consumers,
right,
to bring it out of the macro scale to us everyday people, we can buy a TV, 60-inch TV for $500,
right,
$400, whatever it is now. Nothing. Anyway.
Yeah, we love that.
We love it. We love it. So a weak dollar is the reverse, right? So people buy our stuff, and the other stuff gets more expensive. The imported stuff gets more expensive. So we had a real strong dollar. Now it's coming back down. It's still pretty strong. Again, there's a lot of flight to quality. When there's economic distress in the world, whether it's COVID. During COVID, the dollar went through the roof.
Oh, yeah.
Because everybody was scared. And where are they going to hide their money? Where are you going to take your rubles? Where are you going to take your yen, your pound sterling? You're going to park them in the dollar. Because the dollar is going to be the least volatile and the most stable.
That makes sense. That
can change. Some other threats that we're looking at, the debt ceiling was mentioned. And the national debt. We're currently running a national debt on par or exceeding what we had in World War II.
Right.
Well, World War II was World War II. We had a lot of spending, and we had a good reason to do it. There's been a lot of reasons to spend to keep the economy going through COVID, to help people out during COVID. The housing crisis of 2008, 2009, there was a lot of money put into the system. Basically, since 2008 and 2009, the amount of dollars circulating has tripled. That means, in theory, your dollar from 2008 should be worth 30 cents today. That's not the case because the demand for dollars on the global stage was so high, they just vacuumed them up. It's amazing to watch. From a macroeconomic standpoint, it's been amazing to watch. But again, that's why we don't have worse inflation than we have. We have inflation, but if you look at the amount the money supply has grown since 2008, it's astounding. But the thirst for dollars out there it's not unlimited, but it's very high. So we're running a serious U.S. debt and on level with World War II without a world war.
So that's my problem in my mind is we have war with Ukraine, which I think we should not be dumping the money into. I think it's just a money racket anyway, because we're selling missiles or equipment to Ukraine, who's then selling it back to buyers on the field, who's then selling it back to the defense industrial complex, who then is reselling it back to their own defense industrial complex and the government to then resell back to Ukraine. It's
a big circle jerk.
It's a big circle jerk where certain people in key government positions or government backers are making an absolute fortune, and the defense industrial complex and certain, worldwide leaders and people are making a fortune off of it at the expense of the American taxpayer is what that is.
Right. And we're also using up a lot of defensive surplus.
And that's a problem too. And so if we're already maxed out on debt equal to World War II without a war, what's going to happen should China invade Taiwan, for instance, or Russia goes nuclear in Ukraine, or India, China decide that they're going to go at it because tensions are tough right now.
Oh, yeah. So any sort of major conflict, not to mention something
right.
small like Afghanistan, would give us grief.
Sure. So what are we going to do should World War happen financially?
So financially, this again, going back to the macroeconomic scale, we're running a debt about 128 to 130 times GDP. That would be the equivalent of you making $10,000 a month and $10,000 a year and having $13,000 in debt. So no bank would make a loan to the U.S. right now if the U.S. was a person.
Right.
So our own personal finances, if you had more debt than income for a year, then nobody would make a loan to you. Now, a couple of things about the national debt, and I won't get too far into this, but national debt, a big chunk of it is owed to ourselves. A big chunk of it's owed to America. I think 60 or 70% is owned to bondholders in America. Okay. Then there's that 30% that's owned to foreign entities that have loaned money to the U.S. government. Yeah. It's also, so a lot of it is domestic. It's owed to ourselves. So you can look at it that way. The other way to look at this is we traditionally in the U.S. have not had a debt exceeding our GDP very often. Like I said, World War II and now. World War II, there was a clear reason for it. Now, the reason seems to be that neither party knows how to manage the budget. They're both they spend on different things, but they spend more than they bring in. It's equally guilty. So they got to get a handle on that. And then the only way to control that is really the debt ceiling.
Right.
Is when basically the government says, this is the ceiling. We can't spend any more than this. We're up against the debt ceiling again. There's a lot of tools they can use to kick the can down the street, which is what they've done. They raise the ceiling a little bit, so it takes another year to get to it, kick it down the street to an election year, to the other party, whatever it may be, all sorts of political tactics. But we are running into the debt ceiling. And one time we played around with this too much, we got our debt rating knocked down from AAA to AA as a country. So America had the highest debt rating of any country, meaning they were most confident of us paying on our bonds up until the debt ceiling turmoil. I don't know the year. It was a while ago. It might have been around 2007. It was before 2008, 2006. And we went right up against the debt ceiling, and we threatened that we were at a point where we could not make payments on certain things.
Right. That was not too long post-invasion Iraq, Afghanistan.
Okay, so
it would have been 04, 05, yeah.
Yeah, okay. So basically they toyed with this and did gamesmanship, basically saying neither side's going to blink, we're not going to vote for your thing. And we were at risk of defaulting on payments.
Yeah.
And because we came real close, the international rating agencies took an A off our AAA rating. We're now AA rated country, and it's never come back.
No way.
We've never gotten that extra A back. So you can see how this great situation America's in with this great debt rating, the world's reserve currency, can go away real fast if people don't use common sense. So will the debt ceiling be increased? Yes.
I think so.
It'll have to be. Now, there's going to be a lot of fighting on how it gets increased and what that money is spent on, which is why we have divisions of power in our government. So one group cannot just steamroll everything and do reckless things, whether it be spending or go to war or whatever it may be.
George Soros, Bill Gates, people like that,
Right. It's just difficult with a divided government, right, with divided houses. So that's why the stock market and everything tends to do better when all three major branches are not under one party.
Interesting.
The stock market wants to have divided government because divided government means less laws, more conflict, and the market can run like it likes to. But anyway,
because there's less oversight and government red tape.
Well, there might be oversight. The regulators are still regulating. The IRS is still taxing, but there's there's less new laws. There's this new intrusion because the government's paralyzed or squabbling. Business world loves that because business world doesn't like rapid change. They know how to deal with the laws we have today, and they've been around, and there's no new laws coming. We know how to do business in this environment. Let's go make money. But when a bunch of new laws like Dodd-Frank, which is over 1,000 pages of new regulations, think about that, 1,000 pages, that's how I made my money, because I was in charge of implementing those regulations at the bank, right?
Right.
So it was great for people like me, but man, businesses were just screaming. And all businesses, banks, broker-dealers, insurance, all of them were impacted.
Which then impacts the taxpayer.
Yes. Just makes less lending activity and increases expenses. Okay, what else we got here?
Anything else on world?
Cryptocurrencies. Just a quick thought on cryptocurrencies. I'm not a crypto fan. You crypto millionaires out there, hats off. You timed it just right, and you did good. The people that didn't get out and lost your shirt, I'm sorry, but it's a bundle of computer code that has no intrinsic value. There is stablecoin cryptocurrencies where they're supposedly based on something else like the US dollar, or maybe even gold. Don't know if you could ever get an ounce of gold for your crypto coin.
Right.
But they're probably going to be regulated out of existence. They're the preferred currency for nefarious players at this point because it's very hard to track. There is some good aspects to cryptocurrency as far as the finality of the transaction and the record of the owner of the crypto coin. There is some neat aspects to crypto. It's not all just smoke and mirrors. And indeed, central banks trade currencies on a cryptocurrency type device that can move massive amounts of money very quickly with guaranteed ownership. But it's not your Bitcoin. It's done between reserve banks.
So it's not a no, but a not right now kind of thing.
Yeah, not right now.
It's a 20-year from now.
Yeah, when they get it, when it's regulated, when it's based on something. People will say cryptocurrency, well, there's no intrinsic value, and there's no intrinsic value in a dollar bill either.
Right, except for kindling for firewood.
Well, yeah, at least
I can light a fire with it. Yeah,
you can burn it. You can roll it up and snort with it.
Right.
But the intrinsic value is the faith in the currency, and it's the faith in the currency that makes all currencies, because there's no currencies that are asset based.
Well, gold and silver is faith in gold and silver. It's because somebody said it was worth something.
Yep, and it was the old standard.
Sure.
Before widely manufactured goods. The thing is about a currency, a fiat currency as it's called, it's really the faith in the country that's running it. And right now, if you wanted a currency that was backed by gold, you would have to go with the dollar. Because on the global stage, not just in America, on the global stage, an ounce of gold is priced in
dollars.
A barrel of oil is priced in
dollars.
That's why the dollar is the world's currency.
And you don't see that ever.
Now,
well, maybe not ever, but for the next 5 years, you don't see that going away.
I don't see it going away because there's nothing that can replace it.
I agree.
There's no.
China's trying.
China's going to try. Russia and China are going to try. They're going to try something, maybe some gold-based something.
Do you think they're going to leverage their natural gas and natural resources to try to get that?
Well, as I was mentioning, China was hoarding gold for a long time.
Right.
Now it was to support their industrial expansion.
Right.
Because they've stopped buying so much now. But we thought they were going to try to come up with a gold-based currency. In the end, I don't see anything replacing it yet. Unless somebody comes up with something, a cryptocurrency or some currency that's backed with a hard asset that people have more faith in than the U.S. economy.
Which, if China decides to try to tank us, okay, maybe, but it would take a world stage play before that could even be an option, in my opinion.
And it's very possible that China will assume some form of the dollar anyway, even if they were to manage to conquer us, because it's so much easier. Yeah. All the systems and international exchange is set up for it. It's just hard to replace. And I'll also tell folks that are, the U.S. dollar is going to disappear. It takes a long time for a currency to die. I mean, you look at Germany and look at Mexico. These economies completely crashed. Inflation went to 1,000 Deutschmarks to get a loaf of bread, and they were still using it.
Right.
Until finally they said, okay, enough, and the currency died. People have a lot of faith in their currency, and the U.S. dollar would take a tremendous it'd take a global catastrophe for the U.S. dollar to fail.
Significantly worse than COVID.
Oh my God, COVID's a joke. We've been through pandemics before when the Spanish flu was more deadlier and the country was younger.
I agree.
And it made it through that. So
I will tell you, because Shawn hit on crypto, I was told by some very high-level government players to definitely stay away from crypto. So for what that's worth, definitely stay away.
It's going to be regulated out of existence by governments that
I think so too.
Yeah, that don't want the bad guys using it constantly.
Right, with narco-terrorism and everything, I think it's going to be a waste if you guys jump into it, especially now. Maybe 20 years from now with proper regulations and oversight, and but I don't think
the Federal Reserve has been investigating a Fed coin for a couple of years now. They're getting into some of the later stages and how it could be a highly regulated, controlled type of currency exchange or value exchange, and they're still working on it. But we don't see a Fed coin, which would be really the only big option at this point.
I think so too,
because it'd be backed by the dollar.
So there is. I did see on Robinhood there's a new coin that they're implementing solely based on the dollar.
On the dollar, and those are stable coins.
Yes,
those are the only thing I would even consider dabbling in.
But then you don't make money off of them.
But then they're just going to follow the underlying currency.
Exactly. So then there's no real point in having it.
Just buy dollars.
Exactly. That's where I'm at. Okay, so I'm glad we agree on that. As far as other world, anything else you want to add on the world stage?
Those are the big ones I had. And if anybody has any questions, by all means, let us know.
I have questions.
Okay.
China's playing with Taiwan right now with the blockades, with the war games. If China makes a move on Taiwan, what's that going to do to the U.S. economy, in your opinion?
Okay. Wow.
That's a loaded question, I know.
I'm not paid enough to answer these things. So I will mention this, that if there is a hot war in Taiwan, and I'll just jump to a hot war, they blockade Taiwan, we go to breach the blockade, we get into a naval conflict, and it gets nasty. Inevitably, there's going to be some sanctions, just like on Russia with Ukraine invasion. And then you start getting into the many layers of economic warfare.
Yeah.
And being in the Fed, we watched a lot of things go on in the world of payments and North Korea. And I can say, I won't mention any names or an exact date, but there was a time when North Korea was making some very aggressive moves and China was helping them.
Right.
This was before COVID. And the Fed basically clenched its fist around the international payment system.
Yep.
And China stopped immediately.
Right.
Immediately.
Yeah, like within an hour.
Yeah. I mean, just turned them 180 on their heel, and they walked away from North Korea.
Because they could have crippled them.
Could have crippled them overnight. So there's that's the pulling the cords of international exchange and the FedWire system. That is like the nuclear bomb of economic warfare.
But China has their own version of that now.
They do, but it only works in like 3 or 4 countries. They're trying to expand.
They're trying to expand it. So that's again, I think that's our key play now. But 5 years from now, if they were to really invest in that heavily, I think it could be a problem. It
could be a problem, but nobody trusts it. Because again, it's under command of the CCP, just like the yuan, which intrinsically could have a lot of value because the economy of China is good.
Sure. It's
a command economy that can be changed, and that currency could be canceled tomorrow with no legal due diligence and replaced with the whatever you want to call it, the Xinxi or something.
Sure. So
nobody trusts it.
Back on a world scale, China for the last 15 years, at least 10 years, has done their roads and bridges initiative, which is where they're going. Belt and road. Yep. Which is where they're going around in these third world countries, dumping a ton of money into them, rebuilding infrastructure for the point of investing in Chinese businesses. And then, of course, the CCP controls primary share of those businesses. And it's so China will have a controlling stake in those countries. If they were to start leveraging those in third world countries on a world basis, what could that do to the world economy? That's my concern, is third world countries right now.
So their biggest impact, as far as I can see, and let me touch on economic warfare, levels of economic warfare real quick. So there's basic sanctions like we saw, and maybe sanctioning some people in a couple of businesses. Mm-hmm. Then there's stopping export-import of certain things. That ratchets it up. There's many levels of this, all the way up including the nuclear bomb, which is shutting a country out of the international payment system.
Right.
Okay? America would not do that over Taiwan. America would do some sanctions and do some things that would hurt China, stop some trade. Then maybe China comes back and it retaliates and escalates. But both economies would be hammered with full economic sanctions. In other words, we're not going to trade with you at all. We're not going to import any of your goods. We're not going to buy any of your goods. Both economies would be hammered.
Yep, toast.
It's not real clear at this point which economy would come back faster. America's building manufacturing infrastructure and trying to get tradesmen back to work to actually make stuff here again that we need every day. We make stuff in the U.S. I hate it when people say we don't make stuff here anymore. We make commercial stuff here.
Yes.
But we don't make consumer stuff. You can't find a light bulb that isn't made in China.
Sure.
You can't find, I went to get a clock, at Lowe's. All of them were made in China. The consumer goods have been dominated by China. So if it gets into an economic war, the bad news is you, me, and everyone you're going to have to pay a heck of a lot more to buy your clock and your light bulb and your consumer good, your TV. It might have to be made in someplace other than China or Taiwan. It might have to be made in Europe.
Goodbye, Holosun Optics.
Holosun Optics, hoard them. But yeah, it would have a huge impact on our consumer prices.
Yeah.
And would raise inflation. China, on the other hand, imports 80% of their stuff, or we fund 80% of their government.
Right.
So the U.S. dollars flowing into China buying their stuff is massive. It makes up something like 2/3 of their GDP.
Yeah.
That shuts off. What happens to China?
Right.
They go back to World War I.
It's economic suicide.
It's economic suicide. So it's mutually assured destruction on an economic level. So both players would be sitting there playing this game of brinksmanship with a hot war fighting, both of them nuclear powers. It's just really ugly because there's no real easy way out that isn't painful. And, would this be kept off as kind of an aside? I don't know. And what if it escalates, comes across the sea, somebody blasts an EMP, it's not over U.S. waters or not over U.S. territory, but it's an EMP over the Pacific and blanks out the West Coast. What do we do? Who shot it? Was it Korea? Was it China?
Chinese
was it
spy
Russia?
balloons.
Spy balloons. We just, there's a lot of unknowns that can threaten the economy at this point and in a nasty way.
And that's not what we want. We want stability.
We would like
and that's why I'm thinking the CCP is going to end up leveraging their roads and bridge initiative, and it's called something different, but for what you guys know as roads and bridge initiative. And I think that could be the key with these Chinese government people in place and businesses in place to actually get them on an international payment system.
So that could be it. Again, will the country trust China with the payment system?
I know.
They've made a lot of ports and good ports and deep water harbors in these countries around Africa and South America and even in the Caribbean. And could they leverage those? Yes, although when I've seen the power balance, America has something like 128 ports, major deep water harbors around the world with, under control or we could use. China has like 20,
right,
or 30. There's and they're not in strategic locations. Could they leverage it? Yes. Can they move assets around those places? Yes. Could they hide people there? Yes. Could they hide nukes there? Yes. Because they have a lot of control over those places.
Right.
So it makes for something of an octopus to try to get a hold of. But they're
shifty.
and they're losing a lot of money on the Belt and Road.
I think so too.
It's starting to come a cropper. Now they can burn the money, but it is starting to cost them.
I think so too. The other one last point on world, and I'll get Shawn's opinion. So, like I said, interesting article passed down today from Office Director of National Intelligence talking about 2026, and it was COVID's economic impacts. And they didn't even mention the virus, which is hilarious in this document they just produced. Didn't even mention the virus or any impact, medically. Every impact they listed was nothing but economic. And on third world, specifically, it was 13 third world countries that they were looking at, African, most South American, and how COVID over the next, let's say 5 years, it went out to 2026, but they were saying longer than that. Looking at how their markets, how much they borrowed and all to try to get masks and vaccines, and a lot of the people they borrowed from was China. Whose country benefited more from COVID? China's benefited more than anybody else because they were the ones producing the masks. I think they produced the virus. It's my opinion. This is not fact. I think they produced and released the virus because their country economically was totally collapsing and they were on the verge of a economic collapse like Russia did at the end of the Cold War. And magically, here's this virus that comes out of China, and China's ready with gloves and masks and ventilators and everything they sold on a worldwide scale, so their economy went from almost completely crashed to then straight up again as everybody else is taking a hit. But it's just my opinion. And Chinese allies did pretty well too. Pakistan was the number one producer of masks for a while. And I mean, so you have this little Pakistan, China sitting there funneling them business, and they're making masks for China. But anyway, so I think what this Office of Director of National Intelligence was looking at specifically was what's going to happen to these 13 third world countries who borrowed all of this money, who owe all of this debt and cannot pay for it. And then what is that going to do on a world economy when these countries start to default in a year or 2 or 3 or 4 on all of this COVID debt and the economic impacts that's going to have?
Yes, so could be significant. But it's nothing new.
Okay.
Third world countries have been defaulting on IMF, International Monetary Fund debt, for eons.
Okay.
Countries put money into the IMF to try to help these countries out, and a lot of times it helps, and a lot of times they lose it. They only put money in there they can lose.
Interesting.
China has been putting money into these countries and trying to gain influence more than repayment. And they've achieved that.
Yeah.
Now, the repayment isn't really coming, and they're feeling that. I do differ with you on China's economy. China's economy was growing great bounds before COVID and seemed to be on a skyward shot. They were growing 10, 12, 15%. COVID hit, shut them down to 2 or 3%, which is, by the way, what America likes to have, and that's their worst case. Can you believe the numbers? Again, the numbers are coming out of the CCP.
Right. That's where I'm at.
That's why nobody really wants to trust anything from China, because it can change overnight. We don't know if they're lying on their books or what.
And they, of course, are.
And when you can look at stuff and you can see things happening and good things. The real estate market was about to crash and this sort of thing. But nothing ever really crashes. Why? Because there's somebody in the background either doctoring the books or funneling money.
Exactly.
And nobody really can see it because nobody's talking, because it's all under communist control.
Right.
It's no big deal. It's just, the Chinese economy did take a huge hit from COVID. They did create the virus. I think it was an accident, but because they lost millions of people. Of course, they can afford it. I know that's cold-hearted.
I think they wanted to.
Millions of people. Their vaccine wasn't as effective as the West.
Right.
They were one of the last countries to reopen. They just reopened the whole country.
I think that was for political control. I don't think it had anything to do with the virus. I think that was more planned.
To put the boot on the people.
Exactly. Put the boot on the people to divert. I mean, there was a lot going on in China, in some of the smaller country, areas and demographics that were really having a hard time with the way the government was going and doing things, and a lot of a lot of subversion going on covertly, and then all of a sudden you have people burning to death in apartment complexes because it would be a fire, but they were locked in their apartment complexes from the outside. Mm-hmm. I mean, I think that a lot of that was very much planned and political.
So it could well be the boot of control, but it did hurt their economy significantly. And it continues to do some damage. Now they've reopened, and as the second largest economy now, that's put a spike on oil, and they're building again. They're manufacturing at full force again. So I don't think COVID. They did get a lot of money coming in for the medical goods, but what it did is exposed, which they might not want, exposed the extreme dependence that we had and the rest of the world had on their goods, but also the deindustrialization of America. It exposed all that.
Interesting.
So America now knows they've been deindustrialized largely by their choice.
Sure.
Okay, in free market economy, free market capitalism, whoever can make it the best and the cheapest wins. China was making it the best and the cheapest by using slave labor and child labor and underpaying their people. Okay, fine. That's the way it did. That's what we did to Europe when we were coming on as an economic power. We produced more stuff cheaper than Europe could. We did the same thing. China's following our playbook.
Right.
Japan followed our playbook.
Yeah.
Same damn thing.
Yeah.
They're just following our playbook. They're reading history and saying, how did America beat the world? We're going to do the same thing. China's doing the same thing. The problem is they have 1 billion people.
Right.
A massive economy, potentially. Okay.
Right.
So basically what we didn't realize that we'd been hollowed out industrially as far as consumer goods, textiles, et cetera, plastics, I mean, all of it, shut down factory after factory and exporting it over to China. And then we realized, wait, we actually need some of this stuff to defend ourselves. We need this stuff to function as an economy, to function in maybe a hostile environment where not everybody's freely selling to us. We've become dependent on these countries when there's no reason to. We have all the oil. We have all the natural gas. We have tremendous natural resources. Can we make certain things cheaper and better than other countries? No, not everything. We can do a lot better than we've been doing.
Right.
We've just deindustrialized. We're the first ones to industrialize. We took the lead in the world economy, and then we started selling it off to other people that said they could make it better and cheaper, and they could. And they could make it better and cheaper in China, and then export it, pay the shipping, bring it all the way back here, put it on a truck, and put it in your grocery store. I picked up a bag of Chinese garlic the other day. Beautiful garlic cloves, huge, from China. Why are we importing garlic? And how can they give us garlic cheaper than we can grow here?
Right.
So again, that just shows you kind of what had happened and what COVID just brought to a broad light, in case they were thinking of sneaking up on us, is just how dependent we were. And immediately, both parties now have basically said, we got to stop this. We got to be able to build the stuff we need to survive and defend ourselves in this country. So really expose them. That's why I think they're going to make a move sooner rather than later.
Oh, I do too. Absolutely.
Because they know the timeline's up.
President of China's coming.
He just got a 5-year. They rewrote their constitution to put him in another 5 years. We have elections in Taiwan and the U.S. in 2024, highly contentious. Those countries are going to be tearing at each other's throats or internally, and then they make their move.
And he's got 5 years to do it, and he knows this is his last 5-year stint.
Right.
And he's already promised he wants it done before the 5 years is up.
He actually said, once before 2025.
That's right.
So anyway, I think there'll be a hot conflict with China. This is just me.
I agree.
Hot conflict with China before the end of 2024. Okay.
Me too.
So
glad we got that covered. I agree. Totally. So that brings us to prepping and financial preparedness.
Yeah, and do you want me to talk about the current banking crisis a little bit?
Yeah, absolutely. So Silicon Valley Bank's on my questions, and the LA Bank, and then the people. Now the big question we've been asked is, was a credit union better? And so you can can handle that.
Okay, let's get into the current banking crisis, and I'm going to, again, just stop me if I get start using vocabulary or crazy stuff. So Silicon Valley Bank, why did it fail? There was two main reasons why Silicon Valley Bank failed, and they're called concentration risk and duration mismatch, which caused a liquidity crisis, which is how every bank fails. Every bank fails because they don't have any liquidity.
Right.
What does that mean? Well, they don't have the funds right now to pay their current bills, and it's a liquidity issue. So every bank fails due to lack of liquidity. That's not the root cause. When somebody says the bank failed because of liquidity issues, like, okay, thank you very much. What's the problem that caused that? Okay. The problem that caused that with Silicon Valley Bank and has scared a lot of other banks is a combination of concentration risk. Their clients were fairly wealthy business startup, Silicon Valley digital startups. Yep. Okay, everything from websites to chip makers to everything. And this bank that tried to hire me a few years ago, I was actually interviewing with them, really specialized in these highly complex technology startups. And some of them just went great guns. I think they financed Facebook, they financed Twitter, they financed so many of these names we know today as these incredible places. Silicon Valley Bank was involved. And most of their client base and their loans were made to these groups. They also had a deposit base, and this is even more important, that was made up of those business owners and those people and those executives from those companies that held quite a bit of deposits with Silicon Valley Bank. These deposits exceeded the $250,000 FDIC insurance limit many times. They would have millions sitting in there because it was Silicon Valley Bank, right? No problem.
So on that note, do you recommend that people don't have any more than $250,000 in each account?
Yes.
Okay.
Yeah, so to bring it back to common folk, if you have over $250,000 at a single bank, Or let's say you're blessed enough to have $500,000 or something you want to divide that up between two banks.
Okay.
It's dividing the risk. FDIC Insurance is Federal Deposit Insurance Corporation. Mm-hmm. It's actually a corporation. It's an agency of the government. It's a corporation. It's an insurance company. Okay, so if you got $250,000 at two banks, you've spread the risk. The chance of both those banks failing is much less than one bank failing. And that's insurance company thrives on spreading risk.
Sure.
Right? So that's why they say $250,000 and then put it someplace else.
Okay.
You can go over a little bit or something, but just realize that if the worst happens and there's a big economic disaster or something, FDIC is going to come in and bail you out for $250,000, but nothing more. There is ways to work with different signers on your account to boost that to $500,000, but I'll answer that if there's questions. Credit unions have the credit union member insurance fund or plan. Same limits and statutes as the FDIC, except it's funded by the National Credit Union Association. I think it's called the NCUA SIP or something like that. But it's basically the same as the FDIC, except it's not. It's funded by the credit unions. It's not a government agency like the FDIC. But credit unions are also much smaller and much lower risk because they don't do commercial loans. They do retail loans. They're for people working at Duke Power or Ford Motor Company. They're specific for the employees of particular things. They tend to be, they just do retail. They do mortgages. They do car loans. They do credit cards. They take bank accounts, CDs. But they're not in these more aggressive instruments. Not to say a bank like that can't fail. We saw some failures of the credit unions during the real estate crisis in the early 80s.
Yeah.
But
it's safer. I think usually the rates are better. Right?
The rates are better because they don't pay taxes.
Really?
Credit unions don't pay taxes, and commercial banks hate that. So they can give you a better rate on your deposits and a lower loan rate because they don't pay taxes.
Interesting.
They're considered in a way just like a captive of whatever employer they're working with. I have accounts at a credit union. So I think they're safe. They take on less risk, but they're also much smaller. So it's easier to upend a small boat. You look at a Bank of America, Citigroup, JPMC, Wells Fargo, $1 trillion in assets. Man, those guys can withstand some serious storms because they're so diversified. They're in all parts of the market. Not all parts of the market are down at the same time.
It's true.
So one side is bleeding, the other side's making money. As far as safer,
maybe
it kind of depends on the circumstance, but it's hard to beat. Okay, I'll just come out and say this, and I hate to say it. It's hard to beat the safety of the $1 trillion club.
Sure.
Or even the next level down. The next level down would be like a Truist, a PNC, a U.S. Bank. These are 400 to 800 billion. These banks are so bloody huge. First of all, they're highly diversified geographically and business-wise, and if they were to fail, they'd wipe the FDIC out in a minute. So
sure.
They will make sure they don't fail.
Okay.
But don't, I shouldn't be saying that sort of stuff, but they're huge banks, and it's very hard to upset them. So as far as safety, just diversify your money. $250,000 per bank.
What would be another good way they could diversify their money?
So a lot of people have been running to money market funds.
Right. Okay.
Money market funds are funds that broker dealers and even some banks offer them. These are not FDIC insured. These are backed by treasuries. Well, I got news for you. Most deposits in a bank are backed by treasuries too. Okay. And they're backed by deposits on reserve at the Federal Reserve Bank. There's a lot of things backing those bank deposits. Okay. There's nothing but treasuries backing your money market at your brokerage house, which, by the way, pays over 4%. It's an awesome yield.
It was you say we were talking about Woodsman for Life, and places like that.
So you park in a money market, uninsured money market, you're getting as much as a CD in a bank.
Right.
And it's liquid.
Yeah.
I don't know if anybody remembers this because it was a while ago, but during 2008, 2009, in the financial crisis, the money markets broke the buck. So what does it mean when you break the buck? It's a BFD. And it's only happened once in my lifetime, and I probably can count on one hand the number it's happened in American history. When you break the buck, it means that the money market cannot pay you $1 for each dollar you had in there.
Really?
They're paying you 98 cents on the dollar. In other words, people were withdrawing money so fast from the federal fund, from money markets during 2008 because of the panic, and they were losing faith in the banking system. They pulled money out so fast, they couldn't sell bonds fast enough to replenish those funds, and the money markets broke the buck. Huge deal. Hope I never see it again. And people were not able to get all the money out that they put in those money markets. Then again, you can look at it and say money market funds broke the buck once, like in 2008. How many banks have failed since then?
That's a good point.
Quite a few more. So a lot of people are dumping money in money markets. That's great, but it's all going to come back out. If there's a recession or there's the Fed starts dropping rates, all of a sudden those money market funds aren't attractive anymore, and they're going to want all their money out.
Right.
So it's going to create all this volatility. But that being said, as long as you're diversified, you have some in a bank, you have some in a money market. Don't put all your eggs in one basket if you have that many eggs. If you're fortunate enough to have that many eggs.
Sure. Good point.
All right. So, Silicon Valley Bank, just to circle back, they had a concentration of deposits with these tech firms, and they held a lot of money with these deposits were quite large. Somebody let go on social media that Silicon Valley Bank was sitting on a lot of unrealized losses in their bond portfolio.
Oof.
These bonds are U.S. Treasuries. There is no credit risk with these Treasuries. These are the best bonds you can own. They're U.S. government bonds, right? They're not going to go bad. The problem is when the Fed raised rates so quickly, they had bonds that were 10-year bonds paying 3% or 2%, and now you could get a 10-year bond paying 4%, or you could get a 2-year bond paying 4%.
Right.
So the value of these old bonds that were 10 years till maturity just got discounted. Nobody wanted them.
Gotcha.
Right? So that loss, unrealized loss, is sitting on their books. Oof. Well, nobody really cares about an unrealized loss with a treasury yield, and they just wait it out.
Right.
They're going to get all their money back. The only time it makes a difference is if there's a run on the bank.
And there was.
And there was, because of social media and people and these big depositors that weren't insured and knew they weren't insured for all their money started doing a run. The first time we saw a run like this was on Wachovia, 2008. It's called a silent run. And it is the way runs will be done from now on. Wachovia lost something like $40 billion in 24 hours when they were starting to go down in 2008. Nobody saw it. Nobody heard it. All the biggest investors and depositors just started wiring their money out. Nobody was lined up at the branch, at the bank, like in the old days, people would lined around the block trying to get their money. Nobody lined up. They just wired it out. And that bank was hemorrhaging cash at an unbelievable rate. Same thing happened with Silicon Valley Bank. Nobody was lined up at the bank doors.
Right.
These guys just sat there, pulled up their account on their computer, said wire it out to wherever other bank account they had. Get it out of there. They were hemorrhaging billions of dollars an hour. So in order to stop that, they had to sell some of these long-term bonds so people can take their deposits out overnight. But yet backing those deposits were government securities. That's good. But they were 10-year securities held to maturity that were sitting in the red.
So then the bank loses that.
Then they start selling these bonds at a loss. They're realizing the loss. Their capital cushion gets eroded, and they're in trouble almost immediately.
Right.
And all these other depositors are running. If they were given time, if this panic didn't get out, and they were given time to just kind of ride this interest rate cycle through, they would have been fine. But because there was a run on their deposits and they were long in their duration, they got crushed.
But that can happen to any
bank.
Any bank. Well, smaller bank.
Smaller bank. Every bank, so you have $100 worth of deposits. A bank is not going to keep $100 in the vault to pay it. They wouldn't make any money. They have to invest some of those $100 in deposits in making loans or buying investments. It's the only two ways they can make money, really. So they pay you 1% on your deposits, and they make a loan at 6%. They have something called a margin of 5%. That's your interest margin. That's the heart that beats a bank. That's the most important number of any bank, your net interest margin, NIM. So as bigger or littler that gets, the more money they make or less money they make. So if every depositor of those $100 shows up on one day and says, I want my money right now, no bank is going to have it.
Right.
Okay. Banks can get loans or lines of credit from other banks to try to fund that. There are tools to overcome
interesting.
like a run. The biggest banks have the biggest tools to do that.
Right.
Okay. Then there's the Federal Reserve, which basically backstopped the whole economy in 2008. When people don't realize what the Federal Reserve did in 2008, 2009, the whole thing was circling the drain. The whole capitalistic banking system was circling the drain. People lost confidence. And the Fed came in and backstopped not only the U.S. economy and put dollars out there so people could do transactions, because basically the whole world said, I got my money and I'm doing this. Mm-hmm. I'm not lending it. I'm not giving you any. I'm not giving you any. I'm holding it right here. When the whole world does that, economic activity stops.
Right.
And everything crashes. And the Fed said, no, here's money. Go ahead and make some loans. Don't worry about it. We got money for you here. Low interest rate.
Interesting.
Okay. And when they backstopped the U.S. economy, they backstopped the global economy. Kept the global economy from going down.
Wow.
It's a huge, I hope I never see that again. It was amazing. You could buy Citigroup at 99 cents a share and Ford at $1.25. Do you know how I know those numbers?
Because you bought them?
Because I bought them. There was blood in the streets, and they thought everything was going down and capitalism was over. And I'm buying Ford at $1.25 and Citigroup at 99 cents.
That's amazing.
Because I knew they weren't going to fail.
Right.
Ford was financially in pretty good shape. Just nobody was buying cars because of massive depression.
Sure.
And Citigroup was too big to fail. So yeah.
Right.
99 cents a share.
Interesting.
Anyway, so when people are terrified, that's when you should be buying. But it's hard not to be scared. It was a terrible time.
Right. Interesting.
So that's SVB. If you have other questions about SVB or Credit Suisse, happy to answer those on why they went down. I want to jump into preparing for the future and personal finance.
Yep.
How can we as normal folks, kind of be ready to weather these storms? What are some of the first steps we can take in our personal finance, not only to gird ourselves or armor ourselves against economic hardships or turbulence, but also create a cushion for us to stand on for our long-term needs, whether that be retirement or college fund for the kids or things like that. So prepping for the future, the first thing I would say is you got to have a rainy day fund, an emergency fund, or a fight or flight fund. There's a lot of names for it. Basically, it is a basket of cash, and I'm not saying stocks or bonds. It's cash. It can be in your vault. It can be under your bed. It can be in a bank account that's readily accessible, checking account, savings account. But this needs to be 2 months to 6 months. The more, the better. 2 to 6 months worth of expenses. So I am going to ask the next step is you need to do kind of a cash flow analysis on yourself. What are your expenses? What is your income? Do it for a few months. Everything you do, every expense, your apps on your phone. Yeah, the subscriptions.
Right.
Your power bill, water bill, auto loan, mortgage, rent, everything you pay every month. Do it for a few months to get an average. And then all your income you get for a few months. The more months you get in this calculation, the more accurate your number is going to be. Okay. And determine what is your expenses for a typical month. And of those expenses, what are the key expenses? Okay, there's your power, your water, your mortgage, whatever taxes, things like that, fuel for your car. That is with the amount that you want to have 2 to 6 months worth saved up. Have that in a bank account. That is your rainy day fund. That's if you lose your job. That's if things go bad. You have 2 to 6 months of cushion of expenses that you can pay and not be bankrupt and not be out on the street before you find the next job or the next source of income.
I'm going to play devil's advocate here. So let's say that I've got a student making $2,600 a month is what they bring home. and they spend out $2,300 a month in average expenses. Is there a better way besides trying to scrimp and eat ramen to put $200 or $300 in the account that month? Is there a better way that they can try to make that happen sooner than, 10 months? Yeah, I mean, it might take them a year just to develop a month worth of expenses.
I guess where I'm going is, if that's your situation, that's okay. Yeah, okay. But I'll give you some techniques on how to get there.
Okay.
So if you're in that situation, which is a very tight cash flow situation, right? Yeah. You're just getting by each month.
And that's where a lot of people are right now that I talk to, especially with the increase in rates and groceries and fuel. I mean, it's pretty ugly.
And they say over 60% of Americans can't take a 1 month shock. In other words, an unexpected expense of $10,000 or 1 month of no income without being just done. That's a scary place to be. I was there.
Well, I'm there now. I can't say anything.
So there's techniques to do it, and you don't want to save so much that you end up incurring debt to supplement your cash flow. In other words, in that situation, you said, I got $2,600 coming in, I got $2,300 going out. Man, I got nothing. And we go to a movie, and that's it. It's all that's into my cash. Or go out to dinner one night or something. So there's ways to get started and start small. The main thing is that you start. And what I recommend is, if you have a 401k at work, to take that money out of the check before you even see it. They can take 2%, 3%, 4%, 5%, 6%. And one technique, if you have a 401k, and then I'll get to what if you don't, but if you have a 401k or a savings plan at your work, take a little bit out, 1 or 2%, something that it's not going to hamstring you or kill your cash flow, but it's a little something. You're going to laugh because it's not much money. Believe me, it turns into a lot of money in the long run. Okay, but you just start small. And because you're saving that money before you see it, it's a little easier psychologically to save that money because you're not seeing it.
I've heard that from students who are going, if I see it coming out, then I'm going, oh my gosh, I could be doing so much with that money. Home repairs or a new night vision. Or they're looking at it going, but if they never see it, it's kind of out of sight, out of mind.
They don't see it. So the 401k makes it really easy because it's pre-tax money. It gives you a tax break too. May not be much depending on the amounts you're talking about, but it gives you a tax break to do it that way. Plus, if you have an employer matching, that's free money. So at the bank, they said up to 6% match. So for 14 years the Fed had the same thing. For 28 years of my career, I was putting in 6% of my salary. They were matching 6%. It's 12% of my salary, and half of that was free money. Was
we love free.
The company giving me 6%.
That's awesome.
Okay. And it was tax advantaged because it was pre-tax money.
Oh, smart.
So I didn't get taxed on those dollars as income. So this stuff stacks up fast if you get into it early. Okay. Compounding is a key here. It's many years. I still think I have some of my first 401k statements. It's tiny. Okay. It's not tiny now, but it was tiny then. But mainly you just start. And if you don't have a 401k or one of those tools, get an automatic draft out of your checking into savings. You can set it up at your bank to draft out, again, some small amount, $20 a paycheck, $30 a paycheck. The draft from your checking into your savings account each month, right after your paycheck comes in. That's key.
I need to do that.
So if your paycheck comes in on the 15th, then on the 16th, this $20 gets drafted into savings. Okay. So you don't really see it. It's just kind of accumulating over there in your savings. You don't really see it or feel it because it's being automatic. It's not a transaction you're doing saying, I must save this $20 now. It's just happening. Okay. And when you're tight on cash, and Lord knows, I had quite a few years of that, taking that $20 bill out of your wallet and putting it under your bed or your piggy bank or in your bank account is like pulling teeth.
It is.
I wouldn't do it. So I relied on these automatic tools.
I need to do that because I don't have, owning my own business, I don't have a 401k. It's something that I've got to try to discipline, which I'm trying to work on, self-discipline.
Well, like so many things on this podcast, Ryan, whether it's physical or tactical or faith, it's discipline. it's focusing on it, and it's discipline over time. You've had trainers on here talking about physical training, making training a lifestyle, making faith a lifestyle. Finances, I hate to say it, you don't need to necessarily pay attention every day, but that's how I retired early. I made a plan when I was in my late 20s. I figured out how to do net return on investment and internal rate of return calculations, and I did a forecast 25 years out of what I would need to save at average interest rates or rates of return in the market to get to my retirement goal by 55.
Interesting. Somebody had said something.
Huge long-range plan, and I was so far from it at the time. I was like, this is hilarious, but I started hacking away at that tree.
Somebody said if you wanted to, it's $500 a month from 30 to retirement to be a millionaire or something. I don't know.
It isn't much.
Yeah,
it isn't as much as you think if you start early.
That's the thing. You have to start. Yeah, don't wait till you're 40.
And when you start early, the hardest place to start is early because nobody has any money early. I didn't have any money early. I looked like the U.S. government when I was out of college. I had more debt than I had income. We'll get to that next. How do you get out of that spiral? But I was like, oh man, I'm in bad shape here. I had not a penny to spare. So it's hardest to save when you're young, but that's the biggest gain. If you can, even $10,000 accumulated over a few years will balloon into $100,000 in 10 years. I mean,
but that's invest. It's not putting it in your vault. That's putting it in like S&P 500 or a CD.
S&P 500 or even in CDs or something along those lines. It's this is generally market returns that I'm quoting.
Okay.
So not doing anything fancy. Just put it in the S&P. You can look at the S&P from 1907 to current, and it's this jagged line going upwards. And it continues. It's hard to beat against the biggest 500 companies in America.
Right.
Maybe that'll change. Something with China or something could change that. But the
Anheuser-Busch,
biggest 500 companies in the U.S., I mean, they're going to succeed most of the time.
Right. Yeah, I agree with you. S&P 500. Do you think that's the way to go if you were going to do it?
If without having to invest or getting very sophisticated or anything like that, I know people that have retired early that did nothing but S&P. It's boring. There's no fancy stuff. There's no crypto. There's no Tesla.
There's no cool
Tesla's
guy.
part of S&P 500 now.
Right.
There's no cool stuff. It's just the S&P 500. It's called blue chips. And you just buy an ETF. They're cheap. You get into it and you just start putting money into it. And don't watch it every day or you'll freak out because it's like a roller coaster. But it will go higher.
Yeah. Well, because the economy is always growing. If our economy is not growing, we're going to have far more problems.
And even with the economy growing very slowly or not at all right now, these 500 companies are still making money.
Right, exactly.
And still paying dividends.
And the dividends are important.
They're important. They are. So again, that rainy day fund, 2 to 6 months. Start slow. Don't be ashamed. If it's $10 a month, it's $10 a month. If you can do more, it's fine.
And don't buy night vision or ammo out of your rainy day fund.
The rainy day fund is off limits. That is for when your back is against the wall. And that will give you so much peace of mind when you get some money in there that if you lose your job or you need to move to start a new job, and maybe there's a month where there isn't a paycheck, you have the funds to make it. And if there's an economic issue or something like that, you have the funds to make it. And that will give you so much more peace of mind than flying paycheck to paycheck. Mm-hmm. It'll also allow you to take more chances with your money if you want to invest or you want to spend all your money that month on a piece of a thermal sight. I've been looking at that Pulsar a lot, thermal sight. You want to spend that money on that and something goes wrong, you have that cushion. Okay.
Just replace it.
If you have to replace it if you use it. Yeah. Companies, businesses, the charity I was treasurer for 4 years, this was one of their key elements. And I was with this charity through COVID, and they took some hits to their funding as far as donations and things like that. They had an emergency fund for their charity, and they pulled on it. It took a lot of approvals, but they had it. And then we said, okay, these times are bad. We're using it. When the times are good, you need to replenish that.
Right. Smart.
So it saves businesses. It can save you. It's just the first step to financial confidence, financial free. I would say some freedom, but it's mostly, I should say, resilience.
That's a good word.
Because it's not so much freedom as it is you can take a hit now and not be bankrupt in 2 months.
Right.
Right. Your credit will thank you. Your credit rating will thank you. You're not missing payments. You can weather a storm, a change of job, a loss of job. So rainy day fund is key. Call it fight or flight fund. I think Ryan and I agreed, we have a place in our vault that has a passport and a stack of cash.
Yeah.
Passport is for flying. The cash is for flying. And then there's a stack of guns and ammo that's for fight.
Right.
Fight or flight. You got them both right there. Rainy day fund can be part of that too.
Yeah. Okay.
So let's see. So that's a big step. Rainy day fund is a big step. Do we want to move on to tackling debt?
Yes. So more debt than income. You said you had that out of college. So a debt spiral, is that what it's called?
There's a debt spiral.
Debt spiral.
There's something called pyramiding debt.
Probably it's what I do.
I think I did all of these things.
Yeah.
Although I stopped the spiral early. But so essentially, let me describe a debt spiral and a pyramiding debt. So a debt spiral is you get a bunch of credit cards, you run them up. And let's use your example. What was the income was coming in, $2,600?
$2,600 and I think I said $2,300.
$2,300 is going out.
Let's just go there.
So we have that situation. We have $2,600 coming in, $2,300 going out. We run up credit cards because we want a certain lifestyle. We wanted that new motorcycle. We wanted that new
Six Spear.
Now our credit card payments are $400 a month.
Right.
Now we have $2,600 coming in, $2,700 going out. We're in a cash negative situation. But we don't care because debt is infinite, so we just keep charging. Where we come up short on cash, we put it on the card. Now we're getting groceries with our credit card and gas. And, well, kind of everything is on the credit card.
I'm not there, I'm not there.
And you're in a cash negative situation, so now you say, well, I got room on this credit card, $20,000 limit, and this card's maxed out, and I need to make a payment. So now I'm going to pay my MasterCard with my Visa.
Never done that before.
Okay, now you've just doubled your debt,
right?
And you're in a debt spiral. You're in a cash negative situation, and you're in a debt spiral. You're going down, okay? You're going to need some kind of help. You need to cut your expenses significantly and need to start tackling this debt. That's a debt spiral. Pyramiding debt is you have 3 credit cards. They have $10,000 line. You run them all up. You have $30,000 in credit card debt. Man, this is a lot of debt. How am I going to make all these payments? Let me get a home equity loan. So I get a home equity loan for $60,000. I pay off my credit cards with my home equity loan. Right. As of this point, you're not in bad shape because your home equity loan has a lower interest rate than the credit card. Sure. So you're actually okay here. Okay, this is a smart move.
Okay.
You've used the equity in your home to bring down your debt costs. Okay, and you can pay that off.
Okay.
Pyramiding debt is when you run the credit cards back up again.
Gotcha.
So now you have the $30,000 in credit card debt on your home equity loan, and now you rack your 3 cards up for $10,000 again.
I know people who've done that though.
And you've just pyramided debt. Now you're just putting debt on debt. Oh. And you have twice the debt you used to have, and you're in a pyramiding debt spiral.
I know people that've done that.
Yep. It's because they think the debt's just kind of infinite, and I'll get to it later.
That's the mentality, though, is I'll get to it later.
So how do you get out of this? There's a couple interesting techniques. One,
I'm going to take notes on this.
One is the one I used. I was out of college. I didn't have student loans. Biden didn't forgive whatever I had. What I had is I had grants from the military for a lot of my tuition, but it wasn't, satisfying my spending needs.
Right.
Which I insisted, on having that new motorcycle. Anyway, so I had credit card debt darn near equal to my annual income. I almost looked like the U.S. government. I was still a little better than the U.S. government.
Not that bad.
But it was bad, and I wanted to buy a house. I was renticizing. Renticizing is all pain. There is no gain. You're just paying somebody else's equity.
Exactly.
But I wanted to get a home, and I had a wife abuser living above me. that he was 5'2" and she was 5'6", and he used to just beat this woman mercilessly on my ceiling. Anyway, so I wanted to get out of there, and I had all this credit card debt. So I was like, how am I going to tackle this? The first way I tried, and it started on, is I took the highest interest rate credit card. I looked at the minimal payments required for all of them. I took the highest rate credit card. I made triple payments on the highest rate credit card. Okay, minimal payments on the rest. Bare minimum. Okay. Before I did this, I didn't do this. This is a mistake I made. I didn't do a cash flow analysis before I did this. So we're talking before $2,600 coming in, $2,300 going out. What I did is I said, okay, I got $2,600 coming in, $2,300 going out. I'm going to put $400 on my credit card. And what happened is I was paying down the credit card, but I created a cash negative situation where I needed to use debt again to get by my everyday expenses.
Okay.
So after a couple months, I'm like, my debt ain't going down very much because I'm running cash negative.
Right.
I got to make smaller payments to the credit cards so I can finance my life with my cash. At the time, I was traveling for the Federal Reserve no less than 30 weeks out of the year. And I got per diem, which was supposed to be for meals on the road. I basically starved on the road and lived off per diem for a couple of years. I lived off that per diem, buying me groceries, covering my everyday expenses, and all the rest of my paycheck went to rent and bills, credit cards.
Wow.
And I just scrimped. I just scrimped, man. It was ugly. But, I was working, I was bringing in money. I just had to cut back on my expenses and bring down these highest rate credit cards first. And then once you knock that one down, you have even more money to put on the next one. When that one comes down, you even have more. It's like a raising tidal wave, more money to put on the next one, and they get paid off in an accelerating manner. At the beginning, it's really slow. Feels like you're not doing anything. But then as you pay them off, your debt comes down very quickly.
Wow, okay.
Okay, so that's tackle the highest rate first method.
Okay.
The other method is a little less conventional, and I'll be a word of caution with this, and that is if you have a 401k that allows this, do a 401k loan. This is risky, and I don't recommend you do it unless you have to, unless you're buying a home or you're in a situation where you need to get rid of a lot of debt. But a 401k loan, if you have a 401k, let's say you have a 401k, your employer, another reason to put into 401k, and you have $10,000 in that 401k, and you have $10,000 worth of credit card debt. And maybe you want to buy a home, buy a car, wouldn't recommend it for a car, put a kid into college, go to college yourself, and you want to get rid of this credit card debt. Banks don't look at high credit card debt very well, by the way, because it's immediate debt, and there's no collateral. So you can take a loan out against your 401k. So your $10,000 is your money. It's your 401k. You can't take that money out or you'll get taxed on it and penalized because you're not 59.5. I'm not even 59.5. Anyway, but you can take a loan out against that money. It's taking you're taking a loan out against yourself. You want to talk about pressure. You don't pay this money back. You just ripped yourself off.
Oof.
Okay. So $10,000 you take out of your 401k as a 401k loan. It's not reported to the credit bureaus. It's not taxed. It's basically money you get that you've already saved, and you pay an interest rate on that determined by your company, 3%, 5%, whatever it may be. I think when I took it out, rates were higher. It was like 6%. I was paying myself 6%. I wasn't paying a bank that. I was paying myself back 6% to borrow my money.
Oh, wow.
So I was making a 6% return on what I borrowed from myself.
And then saving your credit card.
Then I've just
interest rates, right?
I paid off the credit cards.
Okay.
So the credit cards are charging me no interest. They're paid off.
Right.
My credit rating goes through the roof because I just paid off $10,000 in credit card debt.
Wow. Okay.
Right. They think I'm an angel.
Yeah.
And there is no other debt showing on the credit bureau. It's
because it's borrowing its your own money.
It's borrowing my own money. And it's a 401k. It doesn't report to the credit bureau. It's not a bank. It's my own money.
Interesting.
And I'm paying myself back 6%. So it's a secret way to cancel a lot of debt. So what's the downside of it? So I just mentioned, I'm paying myself back 6%. If you look at the stock market in 2021, not 2022.
Right.
2021, the stock market returned something like 18%.
Thanks, President Trump. Yep.
So if I had taken out a loan on a 401k that I had invested in the S&P 500, like we were talking about before, and I took out that loan, they pull that money out of the market. It's now being borrowed. So I would have paid myself back 6%, and I would have missed out on 18% return.
Ooh, okay.
More like 21 or something.
It was high.
Like 21% return on that year. I would have made 6% off myself, but I missed out on 21%. So your opportunity cost in economic term of what you're giving up for what you bought is high if the markets are rising.
Right.
If you took a loan out on your 401k in 2022, you'd be golden because the market's lost 18% and you would be paying yourself back 6%.
6% plus saving your credit card interest rates of whatever that is.
Right. So it'd be golden there. Okay?
Wow. Okay.
But it's a way, I used this tool when I was getting ready to buy my first house, and I had credit card debt, and I basically canceled that debt, and it gave me a down payment on the home without the banks seeing any more debt in my name.
Right.
So essentially I just accessed some like 20 or 30, because that's about what I had at the time, like $20,000 that I could put down as a down payment on the home.
Wow.
And there was no debt appearing in my name because it was loaned to myself.
That's awesome.
So that's how I got into a first home with very little cash. I didn't have much cash in my accounts.
Right.
But I didn't have much debt either. So I got rid of my debt and had cash to put down without any debt showing up
Smart.
credit bureau. And it was all just using money I had saved. That's the reason to use a 401k. Not so you can dip into it, but you can take a loan against it.
Smart.
So a lot of people don't know about these techniques. So yeah, again, as far as taking down debt, you have tackle the biggest interest rate first, triple down on those payments, do the bare minimum on the rest. You'll get to them later. Just don't pay down so much on your debt so fast that you're in a cash negative situation. You need to run more debt to get by.
Been there.
So you need to do analysis on your cash flow and what you can afford to pay down.
Nice. I like it. Anything else before I ask questions?
Go ahead. Yeah, let's ask questions on debt and rainy day fund.
Debt and rainy day funds. Okay, here we go. So, of course, the grocery stores are through the roof just to buy groceries. And I saw an interesting article. It said 17% of people in America are currently living off their credit cards. 17%. Because people's like high expensive living and the wages haven't caught up. And so the people who are living credit card to credit card, or let's say you bring in $2,600, spend out $2,300, and you want to have a rainy day fund, but the cost of groceries is increasing and your power bill went up, and now all of a sudden you're starting to run, bringing in $2,600, spending out $2,600, super paycheck to paycheck, or you're in that position. Do you have any tips for those people who are running, $50 plus or minus every month, or who are having a hard time with the grocery stores? Do you have any advice for that?
So that is a very tough situation. And I feel for you if you're in that situation. I think, I've been very close to that situation.
Sure, yeah.
Well, what I did and what I'd recommend, you really got to take a close look at your expenses.
Okay.
What is critical? What do you absolutely have to have versus what is nice to have? Do you need that Disney Plus subscription? Do you need...
my lifestyle says yes.
Yeah.
My lifestyle says I need my ribeyes,
You need your ribeyes. So do you need a ribeye? Can you get by with something less?
Not a sirloin.
And does it need to be as big?
Right.
But it's, we all know about the top ramen diet. I was on that for a while.
Yeah.
It's just really knuckling down to bare necessities to see if you can get some free cash flow.
Smart.
To turn that from 2,600 in, 2,600 out to getting some kind of freeboard cash flow.
Even if it's $100 a month.
Even if it's $100 a month. And at that point, savings is extremely hard. And I know it is. And maybe you don't save for a couple of months. But if you can, even put the change in your pocket in a piggy bank, that accumulates. Something as minor as I started saying, if I have any singles, and this is back when people used cash, if I had any single dollar bills in my pocket and I had change, I'd put that in a dish. I do.
I still do.
And, because I was stripping at the time. No, I'm just checking.
Right. I'm not kidding.
There was that change. I mean, it ended up being a bucket of this stuff.
Right, yeah.
Right? And that ended up being like $120 and change.
And then what do you do with it?
So that you can either save,
okay,
or because it's found money, it's something that you didn't expect to get. Anything with found money, and this is another bit of advice. So a bonus you didn't expect to get, never expect to get a bonus, by the way. They say we pay out a 5% bonus, never bank on it. Never expect it, because it can go away with a snap of the fingers. So a bonus, a tax refund, all that was what I call found money. Something like, oh, wow, I wasn't expecting this. Here it is.
Right.
So what I did all my career is when I had found money, I would spend half on me, celebrate, let's have fun, this is great, and save half.
So would that go into an investment or rainy day fund?
Wherever you're at. If you don't have a rainy day fund, put it in for a rainy day fund.
Rainy day fund should come before investments.
Yes.
Okay.
Rainy day fund comes first. That's the first thing. You got to be able to survive a storm before you're going to save anything.
4 to 6 months?
4 to 6 months.
Okay.
And the reason being, like, let's say you don't have a rainy day fund and you're putting money in the market and you have no cushion and the market's down like it's been, and you lose your job.
Right.
Now you got to sell those securities at a loss because you have no choice. You have no other funding.
Yeah.
The bank account's not going to lose money. You may not make a bunch, but it's there for you when you need it.
I even know people who like hot water heater breaks, but credit cards are close to maxed out. And so if they did have a rainy day fund, not that it's great to dip in for a hot water heater break, but it is an emergency.
And that's when they say 17% are living off of credit card.
Yeah.
Over 60% can't take what it was, a $2,000 car repair or something without upending their cash flow.
Right.
Because credit cards are maxed.
Right.
I mean, it's bad. You got to have that rainy day fund to cushion some of those blows. Otherwise, it all comes unwound.
Smart.
It's like your first layer of armor.
Right. Yeah. First layer. Yeah. First line gear, the gear that's touching you, you immediately access.
And it's the stuff
always
that,
with you.
Yeah. Yeah. And that's, you need to have that or anything can get you.
Yeah. Interesting. That's a good point.
What other questions do you have?
Ooh. Okay. Perfect.
Any questions from the audience?
Ooh. Audience questions. Oh, Britt says no. Oh, it's terrible. All right, I'm going to keep going then. Okay, so Britt and I and you were talking before the podcast. I'm 29, and Britt's close to my age. I don't know how old she is, but she's close to my age. And a lot of guys my age, I went to high school with and college with, some of my best friends in the world. Most of them still live with their parents. Most of them. Unlike your generation, who my parents, when they got married at 27-ish, younger than I am, immediately got married, got a house. That's just kind of what everybody did. My grandparents, same thing, 25 or so when they got married, got a house. And due to the economy today, it's hard for people my age or younger to follow that trend. Most of them are still living with their parents, even married, still living with their parents. I do have some students and friends who are wanting to get on their own, but don't know if it's possible. Or even worse, have since they're my age, 28, 29, 30, and now they're going through a divorce. Or now they're trying to make it on their... I don't know how... I honestly don't. You guys who are doing it right now, that is amazing how some of you guys are thriving in some of those environments. But how do you have any advice for those people who are my age, who want to get a house, but they just can't get ahead, or they don't know how it's possible, or for the guys, I have a couple students right now who are going through a divorce and they don't know how they're going to go to a single income family. Any advice for them?
So those are a lot of different scenarios, and it's hard for me to advise on all of those.
Right.
I would get back to the rainy day fund, that if you have that cushioning, it's going to make any of those events easier to deal with.
Very smart.
If you have to move, if you're going through a divorce, if you're going back to one income, okay, well, at least you know you have a couple of months you can get by until you can get either a better job or get your costs. I mean, if you're going to a single income, find a roommate, look at your costs, take a deep dive on your costs, see what you can cut.
Might be going from 2 vehicles to 1 vehicle.
To 1 vehicle, sell one, pay off the other with that. I mean, you really have to just kind of buckle in and get tight with the money, but it's, again, that cost, that income expense, that cash flow analysis is going to be key.
Free up cash flow, I think, is my advice. Is free up as much cash flow, like you said, pay off, sell the one car to pay out. I know some of the guys, they have 2 trucks or a truck and a car. Sell one. I know it might be terrible, but sell one to pay off the other. Then that frees up the cash flow that you would be making on a car payment.
Car payment, right.
You can then put towards rent. So I think anything you can do to free up cash flow, in my opinion, you're definitely the financial expert. You will know.
When you're younger, that is key. It's all about cash flow. And
smart.
And cash flow opens up the ability to set up the rainy day fund. It sets up the ability to invest in the future. You got to get a positive cash flow. If the other thing is keep your eyes open for opportunity. Okay. And I know that sounds like a platitude, but right now the economy is changing in the U.S. I know at least 3 people that have called me screaming for carpenters. Yeah. Carpenters are writing their own ticket right now in this region and across the country. Building houses, building furniture, carpenters are in huge demand, and there's a shortage.
Yeah.
Maybe the trade that you're in or the business that you're in you're kind of capped out there. There's not much chance for advancement. Advance yourself. Get a trade. Get a skill. Get a certification to get that higher income. I was mentioning to Ryan that I have a bachelor's degree. That's it. A bachelor's degree in economics. I wasn't even a straight A student. In fact, my first couple of years were not very good. Then I went in the infantry and got new motivation. But that's it. What did I do with a Bachelor of Science in Economics? Okay. Well, I went and got certified as a certified regulatory compliance manager, a certified fraud examiner, a certified anti-money laundering and financial crimes professional. All those letters after my name, if you've ever received an email from me. Well, that got me better jobs. Got me better jobs, higher paying jobs. So the income line was up, okay? So I might have bought a house that was at the max of my ability. I was like, man, I'm right on the edge here. I'm buying as much house as I can buy. But within 5 years of salary increases, now it was easy. Right. But again, I had to invest that time and work after work on getting those certifications. And it sucked. I won't sugarcoat it. It was painful. I remember taking a certified fraud examiner has 6 tests you have to take. I remember taking one of those on Christmas Eve. These tests they send to you as electronic, highly secured, passwords, all this encryption. And you're taking this test on Christmas Eve. It's like, okay, this is what I have to do to get to the next level. So keep your eyes open for opportunity and get the skills on something that you enjoy, something that pays you what you need, and something you're good at. That's the 3-legged stool. I
got to where I am now, but all during college, during high school was opportunities, and it was during college, it was really, really long weekends of taking at some point 21, 22 credit hours a semester and working. On top of, and so the weekends, I would pull 20 hours a weekend, 10-hour days, and then go right back to 10-hour college days. And But it was that personal growth, and it was some jobs I took where it even was like a volunteer RSO position for 3 or 4 months where I'm eating that expense, as a freshman in college, just to then learn some RSO, maybe get that certification, and then okay, we can grow and then move on. And so there is that constant personal growth. So that's how people go, man, you did a lot of stuff and doing contract work and things at a young age. And I did, but I didn't drink, I didn't party. I never went to a single party in high school or college. I worked, and it was that constant growth. There was that drive.
And I came out of high school as a certified plate welder.
Yeah.
So I was an iron worker before I was a banker or anything.
Right.
And, that earned good money.
Yeah.
But then I also realized, man, this is really hard work. Maybe I need to sit on a cushioned seat in a bank. But that I always had that skill to fall back on. I remember as a 20-something saying, well, if I can't handle it at the bank or they let me go, I can always be a welder.
That's right. Yeah.
And then went in the military, and now I had another step. I said, well, everything goes to hell in a handbasket. I can always go back in the military.
Right.
Or be a welder. So now I had two of them. I maybe could be a welder in the military. No, I was infantry. But anyway, you get these steps, these fallbacks.
Yeah.
It enables you to take more chances going forward, because if you fail, you have something to fall back on.
Absolutely. It's a personal growth. The coolest guns that I own, and the most expensive guns that I own still to this day, I bought between 18 and 21 because I was working, making money, and it didn't have any expenses. Right. And so, the time, like Shawn was saying, with investments, start young. And the older I get, the more expenses I pay out. And I'm not married, don't have kids yet or anything. So I think if you can really discipline yourself to grow, and I think the best time to grow and get all those letters is as early in your career as you can.
To your point, people, staying at home.
Yeah.
Okay. Because of real estate prices, rental prices, job market, what have you. The big advantage of that is, and I'm not going to say I left home at 22, like somebody, I didn't. I think I left home at like 25, 26 after I was out of the service, after I graduated.
Yeah, I'm right there, yep.
And so it wasn't, I bought my first house at 29. So the move was quick from there, but I didn't get out of the house at 22.
Right.
But what you use that time for, because you're in this ideal situation, you're at home, you're stable, you don't have a lot of expenses, you can save money and get that rainy day fund built up. You can also take extra courses like what you were doing and get that certification in something you're interested in, information technology, videography, carpentry, ironworking, whatever you're interested in. You can go out and get those certifications. The world is going to want certifications. If you don't have a degree, even if you do, they want some kind of professional certification for the particular area you're going into.
Absolutely.
And those carry actually quite a bit of weight. People might scoff at them, but I've seen it firsthand where they make a difference between being hired and being promoted and nothing at all.
I'm right there. My whole job history has all been on and the right doors opening because of work ethic and everything. I mean, it's all it is.
Yeah, I mean, employers see that you put the time in to get that certification, whether it's a journeyman carpenter or a certified fraud examiner or whatever. They put the time, certified physical trainer. I mean, there's all sorts of things out there in whatever you're interested in. But while you're at home, you have the time and the flexibility to do that stuff, as opposed to, scrambling, at your first job where you're working overtime. And then it gets really tough to put in the time to get a certification on top of it.
Yeah, and diverse, just like you want to diversify assets, I would say diversify yourself some too. I mean, in the contract world, I long range shooting, and I got into that, basic rifle, pistol. Then I thought, man, the medics are like, that's where the money is right now. So then you start diving down this 1.5 to 2 year trail for medicine, and then I think that's something that helps our staff is we do, like guys like Bush and stuff who have been in it for 10 years. And it's an ability to be multifaceted. It's whether it's CQB or tactical medicine or long-range shooting or hand-to-hand. You've got a diverse, you go everything from long-range shooting to archery to concealed carry. There's a widespread multifaceted, diversification there.
Diversifying skills is always handy, and I'll never regret my experience as a welder or as an infantryman, even though I ended up as a banker in a corner office, right? Yeah. Farthest thing from mud and blood, and but the lessons learned and the leaderships learned in those situations was worth a ton. And people say, well, why'd you go in the infantry? That doesn't give you any real skills. And no, I didn't come out as a diesel mechanic or as a combat medic, or I came out as a sergeant, in the infantry and a sniper. And it's like, what's that going to do for you? Well, what it taught me was discipline and leadership and how to lead people under duress. We talk about all the stress of the work environment today. To me, that was a joke. I mean, compared to military stress, right? Right.
Sniper school or anything else.
Any of the rest, and leading guys that are exhausted and haven't eaten for 2 days. And so it's a good diversified skills is a big thing. You do want to specialize.
I agree.
You want to specialize and get certified in what that main thrust of your career.
Right.
And do that.
Any other thing you want to add on financial? Off your checklist?
I think it's most of it is just wrapping up. If you do have your emergency fund, you have your emergency plan, you have your disaster survival plan, you've got your immediate needs of finances taken care of, you've got your rainy day fund, et cetera. Now you start looking into longer term. If there's more questions on longer term, I'd be happy to do another talk on that. But that's when you're starting to invest in the stock market, in bonds, maybe in real estate. Stuff that you're going to be in for a long time. You don't need to cash out on this stuff. This is your long-term investment for kids' college, your own retirement, your own home. There's a lot to that, the longer-term plan. I will say, just like all the tactical lessons here, you need to have layers in your plan. You need to have an immediate action plan, which is your emergency fund. Yeah. You need to have a longer-term plan, just like you need to have, your prep bag, your get-out bag, your longer-term, stay-and-fight bag, your dry goods, your canned goods, your medicine, beans, and bullets. You need to have layers to these plans, and I know that takes a while to set them up, and it's a pain, but just focus on it a little bit, put some money aside, and it'll come.
So I have a couple other points why I have you here. I'm going to use it to my full advantage. So you said something so keen to me when you first came on board, probably like a year ago. And I don't even remember if you remember saying this, but I was talking to you and Rishi, and you talk about my retirement and my financial future, essentially was what it was. And I was like, yeah, I'm like about guns and ammo and gear, and that's like my financial future and preps. And you and Rishi looked at me and you said, yeah, but what's your prep if the world doesn't end financially? So I do have a lot of students, and I love you guys because I was one of you until about 6 months ago, who do spend a majority of their money on guns, gear, night vision, preps. Not that I'm against it, but your advice on what they also, not instead of, but also should be doing. And it's one thing to be prepared for when the world ends, but what about being prepared for if the world doesn't end? Because some of us didn't have a retirement plan or any savings accounts or et cetera.
Mm-hmm. So the mentality of live for today and the world's going to end anyway, so who cares, is shared by the whole World War II generation.
And me.
It's not uncommon. There's a lot of reason behind it. World War II, the great generation, I mean, they were like, man, and even my father said, I'm not going to live to see 60.
I never thought I was going to live to see 30, and I'm 29.
They're like, I'm not going to live to see 60. It's this hard life, hard working, work hard, play hard sort of lifestyle. And he didn't realize until getting later in his life that, wait a second, the 60's not that far away, and I'm not in that bad of health, and started saving late, aggressively, but late. And we were fed chicken dogs for a long time and top ramen as a result. Anyway, but if the world doesn't end, the world's a pretty resilient place. If you think America is going to fall from grace as the world's leading power, maybe we fall from grace like Germany or Britain.
Yeah.
Britain's still a world power.
Right.
And still a big economy. Are they the global leader that they once were? No. Does the world end in a big nuclear flash? Maybe. There's a lot of reasonable people that don't want that. Does a super virus wipe us out? Does a meteorite hit us? All these things are possible. But what if they don't?
Exactly. And that's, I wasn't looking at that.
Just as if they haven't so far. I mean, so in my lifetime, I know a lot of older folks that say the world's going to end, the apocalypse is upon us, that all the signs are there. But that's been said since World War II as well. Sure. So what if the world doesn't end? You need to have a plan. You want to retire someday, hopefully. You don't want to work right into the grave. You got to start setting up for that early. And even if you don't, if you're saving up, even if the world ends, dollars are probably going to be valuable for a big portion of that ending. And if you have reserve money and you see the world coming to an end, like the balloon has gone up, if you have money in your rainy day account, you can buy beans and bullets, bandages and guns.
Yeah.
You'll have a reserve fund to do that.
And at that point, I think it's going to be back to the barter and trade system anyway.
And it'll be barter and trade. And you can say, well, the dollar is going to lose all its value. The dollar is doomed. I'm going to buy some gold. Well, the gold is priced in dollars. And who's going to set the price of your gold when you have gold versus refined goods? How much is an ounce of gold worth in bullets? Is it 308 or 5.56 or 222 long rifle? And will I trade that knife for a bar of gold because I have no knife to carve the game?
That's where I'm at.
There's gold was the gold standard for when there was not many refined industrialized goods. Everything was handmade.
Ancient Egypt.
and it was a great medium of exchange.
Yeah.
Now we have refined goods or industrialized goods that are really good medium of exchange. There's a large group of people that think the 22 long rifle shell is going to be the dollar of tomorrow.
Yeah.
Because you can hunt with it and live with it.
Right.
So people are going to barter all their value for
22 long rifle.
Ryan has talked about having some meds available. How much gold are you going to give up for a dose of antibiotics when your kid's sick?
Yeah, and that's why all these financial preps, what we hear, and even PrepperNet, there's some prepper groups, and the leadership pushes buy gold, buy gold, buy gold. You should have gold in your vault, and buy your gold for me. And now I have a company that you give me all of your financial assets and I turn it into gold that I keep in my vault that you never see.
But I'll give it to you if you want it.
I'll give it to you if the world ends. There's a lot of stuff out there.
Yeah, don't do that.
Please don't. And my thing is, and the elderly preppers, not that the elderly are dumb, but just it's a different mindset. The preppers who are elderly are falling victim when they're doing that. They'll have $10,000 or $15,000 in gold coins, sitting in their safe. And because gold's been backed for so long, or I know one guy, he's a student, he just buys gold chains. All the gold chains that he can find, he buys them. And he has Tupperware containers of gold chains in his safe because they're less expensive and he can do it by ounce for ounce. And I'm going, yeah, okay, but your kid's sick and I have antibiotics. You have gold chains. How many gold chains are you going to give me for a bottle of antibiotics? But the problem is your gold does nothing for me. I don't want your 2-pot gold chains. I want my bottle of amoxicillin. It's going to do more for me.
Yeah, and it's gold has great industrial use. It has great jewelry use, and it's kind of been a standard of value. Silver too, platinum too.
Commodity.
It's a commodity,
yeah.
But without a central kind of basis of value, which is they're priced in dollars now. Right. Do I say don't buy any gold? If you want to buy some gold coins, some Krugerrand, some 100% gold, that's part of a diversified investment strategy.
Sure.
Go for it. Don't let anybody else hold it. Keep it in your vault. Keep it under your control, in your safe deposit box, what have you. That is your gold. That's your hard gold. The beauty of having gold is that you control it. If you want to sell it, you can take it down to a shop and sell it. Although I'll tell you, if you think you're going to get the spot rate for your 5 ounces of gold or your 10 gold chains, you're not going to get anywhere close to the spot value. That's for industrial gold exchanges. Right. You're going to come off of that 20%. So if you're looking at the price of gold is rising, that's good. That'll help you. But don't think you're going to get that dollar per ounce that you see on the TV. Nowhere close.
Exactly. And would you be better off? You have $500 to spend. Do you want to go buy $500 gold coins? Would you be better off going and buying a case of 5.56 and a case of 9? I mean, maybe.
I'd say a case of 5.56 and a case of canned goods.
I mean, right. I mean, exactly. What I'm saying is, and like Shawn said, if you just have lots of excess cash to diversify, great, buy your gold and silver. But if you're one of those where you're buying gold and scrimping money to buy gold for poop hits the fan, I think there's far better purchases for you. It needs to be a diversification reason, not a preparedness reason. If that's where I'm at with it, as long as you agree with that.
I mean, after all, even the world of John Wick, there's an economy where those gold coins have value.
Yeah.
And it's probably priced in dollars.
Right, exactly. You said something, start early. Reiterate in like a couple of sentences, what is the importance of starting early? And even if you're 40 or 50, it's not too late, but do it like now.
Yeah, the earlier you start, the less you have to save because of compounding. So without getting into the rule of 76, Rishi knows that rule really well.
Yeah.
Essentially, when you get into compounding, and I'll just do a quick explanation. So you have $100 to save, and you buy $100 worth of Duke Energy stock.
Right.
Duke Energy stock is paying a 4% dividend.
Yeah.
Okay, I don't know what they're paying. Let's say it's 2%. So what happens is you buy $100 worth of Duke Power stock. They pay 2% dividends, so the next year you have $102.
Yeah, I think Duke Power is currently at 5%.
5%, $105 after a year. You reinvest that into Duke Power. So now you have the $5 worth of dividend. You started with 100, now you have 105. Now you're getting a dividend on $105. That's the way it works with a savings account. It's called compounding. In dividend, it's called reinvesting your dividends. When you take a close look at the S&P 500, in the history of the S&P 500, and you look at how much of the gains over the years, that is assuming reinvesting the dividends of America's top 500 companies back into the S&P. When you take the dividends out of the S&P 500 and look at total gains over time, they drop by about a third.
Wow.
So that's not just the stock value of the S&P 500. It's the stock value of the S&P 500 with dividends reinvested every year for 100 years.
Nice.
So that happens the same with you. So if you have a savings account and it pays a CD and it pays 5%, you invest 100, you have $105 at the end of a year, you reinvest that. Now you're getting interest on interest. Now you're getting interest on $105 instead of just 100. So it's called compounding, and it has tremendous power over time to turn money into tremendous sums. Now, at interest rates in a bank account, it'll take a while for it to become big. But in the stock market, when you have an average annual return of 7 or 8% for the S&P for the past 100 years, and 7 or 8%, it takes about 10 years for you to double your money with compounding. So you put in $10,000 when you're 30 in 20 years, and it doubles every 10 years, double the double. So it doubles to $20,000 by the time you're 40. 20,000 turns into 40,000 by the time you're 50. You see the effect.
So that's why it's so much more important to start early, because you're doubling your money an extra decade or two.
Yeah, it gives that extra decade for your money to grow.
Which is really where the growth happens, is the first couple decades.
It is. And as an example, I had a 401k at the Fed that I had for 14 years, and I rolled very little into that. I was 27 when I joined the Fed. So I was there for 14 years, and I was putting in the 401k, and they were matching. I took that money when I left, and now I was 41, and I went to go to a bank, and I took that 401k, and I shifted it to the bank, but it was considered it was a rollover. It's when you roll over your 401k. But it was kept in a separate account, earmarked separately. It took me all of 14 years or more getting paid more money, making bigger contributions into my 401k to catch what I had saved for those first 14 years, because it was just working in the market. So it took me It took me 16 years of making bigger contributions to catch what I'd made in those first 14 years, earning a fraction of the salary. It just showed me firsthand as I was watching these two balances, the one at the bank and the one at the Fed, and it just took forever to catch that old balance because it was just growing with the market.
What do you think someone realistically needs to put in per month to safely retire if they're, let's say they start at 35, $200 or $300 a month, or $500 a month?
So you're talking 35, retirement age is 65?
Yeah.
So you're talking 30 years? I would have to pull out the calculator to give you a good number. The one number given before, the $500 a month will get you there. You might be able to do it with less.
Really?
It depends how you're invested and what kind of risk tolerance you have. Mm-hmm. But $500 a month, I would think, would definitely get you there because that's $6,000 a year.
Right.
$6,000 a year times 30 years, 180,000. Now you get into market compounding.
So double the double because it's 3 decades.
Right. And you start getting real close to $1 million.
Okay.
$1 million is not what it used to be.
Right.
But it does have some pretty serious. You're getting Social Security and you get 5% on your $1 million. You're getting 50,000 off your $1 million. Then you get your Social Security.
Because your
dividends. A lot
dividends.
of people can live off that. Yeah.
Smart. Okay, so I've got 3 more things. Any tips for cyber or protection with cyber and banking?
Whoa.
Which I know is not where, but like if you had to say like 1 or 2 tips, any tips for protection against cyber or...
Are we talking fraud attempts or are we talking...
Yeah, let's say like fraud attempts or just cybersecurity with banking and that kind of thing.
Yeah, so the basic stuff, I think most of you already know. Change your password. I would say twice a year, at least annually. These passwords do get out when there's hacks. And it's not even just of your bank. It might be vendors of the bank. It might be your internet provider. I mean, these passwords get out. So change your password. Make the password for your bank account unique for all other passwords. This is your blood money. Do not use the same password you use everywhere else. This is special. Same with your investments. Unique password just for them. Make it very different from all your other general passwords. A different theme. As far as cyber security and fraud, the electronic fraud now, and people sending you text, people sending you emails, leaving you voicemails, the fraud is rampant because these guys have no downside risk. If they get 1% of the people biting on their fraud, they make $1 million.
Right.
The other 99% they don't care about. Don't be the 1%. If you get something, and I've helped out some elderly folks.
I was going to say your passion right now is really helping out the elderly.
It's fraud.
Fraud.
Elder abuse and fraud.
Yep.
And I've helped out several neighbors that have been defrauded. Again, we've captured your computer account. We've encrypted your data. Give us go get a Bitcoin account and give us 20,000 in Bitcoin. Again, not trackable, and they do it. And they go by their bank, and they don't call their neighbors, and they don't call anybody because they're ashamed they've been hit. I've been defrauded. I'm a certified fraud examiner. That's part of the reason I became one. I got defrauded. It wasn't a lot of money, but it woke me up that these guys are very sophisticated. They're very clever. Do not, if you have any question about an email, a text, or a voicemail about your account being frozen, your account being taken over, there's been attempts on your account to get in, call your bloody bank, talk to a person. Don't click on anything in the email or the text. Go to the bank's website that you know and see if what they're saying is true. If they say they've I think I received an email a week when this whole thing was about, you got this text message or this email saying, we've looked at your account, your computer account. Some very interesting pictures on this account, and half the sentences were misspelled. And but we're reasonable. We're not trying to really bankrupt you. We just want $15,000 in Bitcoin.
Right.
And they're trying to play nice guy, but they've encrypted all your stuff. It's all BS. They didn't encrypt diddly. They didn't have access to my account. Right. It's all just a phishing expedition. So just
see what you'll bite on.
Don't bite on it. And don't click on anything in that email. Because if they say your account's been frozen, click here to unfreeze it. Don't click there. That's just going to their website. And don't call any number on there. They just have a call center ready to rip you off. Call your bank. Go to your bank.
I would tell you, it's actually so sophisticated. I had an ex, and they called her and said, "This is so and so with the local Department of Justice. Specifically, I'm a fraud examiner with the FBI." And said, we see that you graduated from so and so college this date with this degree, and you took out this much in student loans. Looks like that you have defaulted on student loan payment. We need you to verify your student loan account information so we can get this cleared up.
Yeah, we need your social security number. We need your date of birth. We need your...
She hung up. She called me on her way to work. She goes, "Is this really a thing?" I said, no, give me the number. And so doing what I was doing at the time, I put the number in my phone just to call. I was going to call it. As I typed it in, it popped up, a contact saved. And it's the FBI office in Raleigh. The phone number came back to them. And I went, whoa, okay. So I called her back. I said, look, I'll call. I said, but I will be honest, I'm going to go call that number. When I call that number, I typed in the number you gave me. It popped up in my contacts, a saved contact, and it's the FBI field office in Raleigh. It says, hold on. And so it was actually the Fusion Center. So
they had spoofed it.
They'd spoofed it. So I called one of the buddies at the FBI was in Raleigh. I was like, hey, look. And then she called, and one of the ATF officers answered at the Fusion Center. And they're like, no, this is the third call. Can't believe they were spoofing the FBI office's number.
Yeah. Oh, it's crazy.
It's very sophisticated.
Now, I also know that most banks will not call you or text you. They might email you. Now, there is credit alerts for credit cards, and I've received a text that, have you made this charge? So you can't completely ignore them, but anything that's basically saying your account's frozen or something, do not click on anything on there. Go to the actual bank, go to the institution, go in person if you need to. These guys are getting really good. The ones that call you are very good. They're using publicly available information. Mm-hmm. So like the college degree, even your address, your age,
right?
They can get all this stuff publicly. And if they're doing a spearfish, which is a phishing attempt directly at you, I've had spearfish attempts on my mom, who's an artist, and people sending an email saying there's an art show and we would like you to be invited. We know you've shown here, and we have seen your website. Really vicious stuff,
right? And
the only way to tell it is I looked up the art show, and it was close to what the art show was supposed to be, but spelled a little bit differently. And yeah, it was a complete ripoff, but it was a very sophisticated spearfish. You got to be careful.
Last one. Any other financial tips or like top 3 investment tips or anything else you want to give the audience?
Oh, wow. Okay. So the tip for the day or the tip for the week or the task for the week.
Yeah.
Do a cash flow analysis. Do all your expenses. Do all your expenses and all your income. See where you're looking at as far as a monthly cash flow. What do you have? And that'll start you thinking about what you can save. What do you really need versus what's nice to have if you want to free up some of that cash flow. So that's what I'd say would be the first big step, because that'll tell you. And believe me, if you get a loan, if you get a credit card, if you do any of this, or you're a small business, the bank is doing this to you constantly. So you might as well use what the bank is using, because they are going to do a cash flow analysis on you as soon as you fill out a loan application.
Really?
Everybody, car loan, credit card, they are looking at your credit report, and they are building a cash flow analysis on you before they make that credit decision. I used to make loans. That was in the old school. They still do the same thing.
And for investments, I know people are asking about investments. S&P 500 is safe.
Yeah, you don't need to do anything fancy on investments. If you're really, really conservative and worried about, put it in a bank account in a CD. You don't have to put all your money in one CD. They call a CD ladder. So you can put one in 3 months, one for 6 months, one for 12 months, and kind of divvy your money around. So as these CDs mature, you can either reinvest them or take them out for an expense that you may have, instead of having all in 12 months.
Nice.
So build a CD ladder and maybe space your money around. I think rates will be higher. I got a 6-month CD because I think by the time we get around to September, October, rates will actually be a little higher.
Me too.
They're probably going to do 1 or 2 more bumps. So then I'd reinvest in that higher rate. When they're done doing interest rate hikes, you're going to see a ton of money rush into CDs to lock in for 60 months. Just an FYI. When the Fed says they're done hiking or we go into recession, that's when you go into your bank and get a 60-month CD at 6%.
Really?
Because rates are going back down, and you want to lock it in for as long as you can.
That's a good tactic.
That's how to use the banking system to your advantage.
And lastly, the faith one. We can do this in like 10 minutes. I know this podcast is going long. Faith topic, tithing.
Tithing. So tithing with the church and giving your tithe. And different churches have different tithes that they recommend. And I've heard all sorts of different numbers. I'm
a 10% guy. Just
10% guy.
Going back to the original OG Old Testament.
I would go with your cash flow analysis. I do the same thing with charity. I give to charity as I can afford it. And tithing is a little higher level than charity.
For sure.
And you want to support your churches.
I'm a big tither. I do believe, and I didn't used to, but I'm a solid 10% no matter what. But I have done the work for a few months to set that up, to free up the cash flow to allow me to routinely auto draft 10%. So I do think you guys should get to a position, free up some cash flow to be able to tithe. I know every time a preacher came on and talked about tithing, I'd be like, okay, this dude's just money hungry. But if you go back to Scripture, and even so much of the Old Testament and even like banking stuff is based on.
There is. I mean, that's a 7-year rule for bankruptcy.
7-year rule for bankruptcy
is based in the Old Testament.
Right, yeah.
You had to release all debts and slaves every 7 years.
Yeah.
There's a ton of stuff and actually lending, which they called money servicers, money lenders. Bible didn't look real good. Didn't have a real good opinion of money.
Right.
Oh God, what do they call them? Money servicers? Anyway, of people that lent money.
Right.
But they also set codes for every 7 years. The loan had to be repaid or forgiven. And to this day, if you go have a bankruptcy or a negative thing on your credit bureau, it has a lifetime of 7 years. Then it's expunged from the record. There is a bunch of other financial things that come out of the Bible as far as savings, tithing, and traditions that we still have today that come right out of the Old Testament.
Yeah. And I'm big, if you go back to Scripture, I'll tie this into faith really fast. Tithing is honestly part of covenant to me. And so I know that word's thrown around some, but you have covenants thrown around the Bible, but I do think that tithing is one of those things, guys, that to me is a non-negotiable. It might take you a few months to set up and free up the cash flow to be able to do it. Don't put tithes on your credit cards or anything, but free up some cash flow like Shawn was talking about to be able to tithe. But to me, tithing is non-negotiable. And it's not tithing to expect something back. I know Joel Osteen, I'll throw him out. People like that, well, that's what it is. And even some of the other famous TV preachers that, well, if you're sick, tithe more. That's not what that comes back to.
I look at tithing as supporting your community and your church. So that tithe goes to the church not only to keep it there and support the people that run it, but also to support the people that support the church when they fall on hard times. So
and that's, to me, if you go back to why tithing is important, it's, to me, that 10% is just, I know that I have a successful business because God has blessed me. He has given me the talents and the people, and I love you guys and the platform. And so it's giving God back a small percentage of what he gave me to then, like Shawn said, further the kingdom and take care of the community. And so to me, I think tithing should be, if you do not tithe, even if you don't attend church regularly, to me, tithing is part of covenant. So if you look at the parts of covenant, it's tithing, fasting, prayer, worship, right? There's a few things that are pretty crucial to your faith. And I know some people, actually a lot of people, they still don't tithe. And so I think that needs to free up some cash flow for you to be able to tithe. I think that is very important. And it's part of covenant because honestly, all you're doing is giving back to God what's already God's and what he's already blessed you with. So that little 10%, to me, even on those months where it might be a little bit harder, I'm going, look, all of that's still yours anyway. I'm giving it back. That 10% is meager. So free up the cash flow to be able to tithe. You guys have to get into that, in my opinion. Any other tips or tricks or opinions for them before we wrap it up?
No, I think it's good. I think we're...
Super good episode. You're the man. Thank you for talking to these guys about, financial planning and preparedness and where they're at with finances and tips and tricks. And I took a lot of notes and where the world is and your opinions. And I think knowledge, to me, it's that preparedness keeps you from panic, like we said a few podcasts ago. And so Shawn shed some light on some things happening around the world and some opinions, and it does kind of dispel some of the panic. And that's good because that defeats that paranoia. We don't want that panic. We want to make good, rational, sound decisions, not out of fear, like running on banks, but out of a state of planning and preparedness. Right. And I think that this is what has really set a good framework for starting that preparedness.
And financial defenses are as important as physical defenses, tactical defenses, because as long as you have a medium of exchange and it isn't complete anarchy and either barter or, I'm going to take what you have, there's going to have to be a medium of exchange, and that's probably going to be the U.S. dollar for a while.
I agree. All right, guys, thanks for watching.